All right, well, let's get more perspective on this volatile market. Our next guest says the bull market remains intact despite the recent losses. Joining us now is Mona Mahajan of Edward Jones, and senior investment strategist. It's good to have you here on set.
Great to be here.
Okay, so garden variety correction, even if it came ferociously and fiercely in the course of a day or two?
Yeah, look, this correction was driven in two parts. One, we had a growth scare. Clearly, the jobs report on Friday triggered that. And two, we had this liquidity technical scare as well with the Bank of Japan raising rates. That part of it has been addressed. The Bank of Japan came out and said, look, we're not going to raise rates further in this period of volatility. Now what everybody's watching is this growth scare going to turn into a recession? And thus far, and this morning brought another piece of good news. We're watching the labor market closely. The 4.3% unemployment rate, what does that mean for the economy? Well, one, it is weakening, the labor market, but two, we've seen this clear trend. It is because new entrants are entering the labor market, not because folks are getting laid off. And so to us, that leads us to, the conclusion that right now we are not seeing a consumption scare, which could lead to the recession. Jobless claims supportive of that this morning. If we do have a soft landing, that is a good backdrop. When the Fed is cutting rates and soft landing, much better for markets than when the Fed is cutting rates and we're entering a recession. So that's the base case for now.
Okay. What are the data points that you're watching closely to see whether that dynamic shifts and actually becomes something more recession-like?
Yes. So first and foremost, another labor report coming out, jobs report coming out September 6th before the next Fed meeting on September 18th. Secondly, we are watching GDP growth carefully, obviously. It looks like Atlanta GDP now is looking at 2.9% for the third quarter. Pretty good. We'll get another second quarter reading also above 2%. So, again, not negative by any means. And then, of course, we're watching earnings growth. We're about 80% through this earnings season. We're looking like about 9 or 10% earnings growth. Pretty good thus far, looking towards about 10 or 11% for the full year as well.
One big earnings name we haven't heard from is Nvidia.
Yes.
How important is that for the market, given it's still a few weeks away?
Yeah, look, I think the Magnificent Seven trade, we've seen a little air come out of the tires there. We are seeing the start of what we're calling a rotation, people perhaps taking some profits from that part of the market into the broadening theme, not cyclical value parts of the market. What we think, though, is that for this market to really work, we not only need to see rotation, we need to see a true broadening of market leadership. We think it's good to see some of the tech valuations come back in, so investors have this ability to not only go into the AI tech trade, but do both sides of the market. So growth and value, we think, has room in your portfolios over the next 12 to 18 months. We do think AI is still in the early innings of a multi-year secular growth trend. But Nvidia earnings, to your point, will be key to the trade. We think they have consistently beat. Can they consistently beat at the same pace? Maybe not. But the good news is we're in a better setup heading into this.
So if you want to see broadening, but you still want to own the Mag 7, I'm just trying to figure out what you're really telling people to do here.
Yeah. So
you tell them to own the S&P, in which case they may get hurt in some ways if, in fact, we get a real sell-off in some of those mega cap tech names.
Yeah. So, one thing that we've been saying is if the theme for probably last year and the first half of this year was narrow portfolios are winning. You needed to have tech in your portfolio and you would do well. But the theme, we think, for the next 12 to 18 months is not narrow portfolios. We think you need to have that diversification. And to your point, S&P 500 is a good way to play it. 50% is tech and 50% is not tech. And so we do think that if you want to, make sure that you're producing the alpha you want, you have to make sure that you're looking at your portfolio carefully for both sides of that.